You've probably heard this phrase before, the Fed raised rates again. But what does that really mean for your day-to-day life? It's not just about Wall Street. The decisions made inside the Federal Reserve echo directly into your wallet, whether you know it or not. In this video, we'll break down exactly how the Fed's moves impact your savings, your debt, your job, and even your rent. The Federal Reserve, or the Fed, is the U.S. central bank. Its two main jobs: keep inflation under control, keep employment strong. This is what's referred to as the dual mandate, the Fed's core responsibility to balance both price stability and maximum employment as the U.S. central bank. It doesn't set your mortgage rate or credit card APR directly, but it does set the federal funds rate, the rate banks charge each other for overnight loans. And that one move triggers a chain reaction that touches every corner of the economy. Credit cards and loans. When the Fed raises rates, borrowing gets more expensive. Credit card APRs jump, sometimes overnight. Personal loans, auto loans, HELOCs, they all get pricier. Example, your credit card had a 17% APR. After 4 Fed hikes, it's now 23%. That's hundreds more in interest a year, just for carrying a balance. Another one is you were going to apply for a loan and previously were told one rate, but then upon today's inquiry, rates are different. This happens as there is no set schedule for the rate changes. Mortgages and housing mortgage rates don't move directly with the Fed, but they're strongly influenced. Higher rates equals higher monthly payments, which equals fewer buyers. That slows down the housing market and can even cool home prices. As borrowing becomes more expensive, home affordability drops, which can lead to price corrections, longer days on market, and tougher selling conditions for homeowners. Savings and CDs. Here's the upside. When rates go up, your savings might finally earn more. CDs and high-yield savings accounts can start offering decent returns again. Bonds, money market accounts, and even short-term treasuries also start to look more attractive, offering safer ways to grow your cash in a high-rate environment. Jobs and the economy. If rates go too high, borrowing slows down. Companies invest less. Hiring freezes, layoffs start. That's because interest rates are the cost of doing business. When that cost rises, fewer businesses take risks. Expansion pauses, credit tightens, the economy cools fast. In extreme cases, it can even lead to a recession, all in an effort to slow inflation without crushing job growth. So what does all this mean for you? Whether you're making $40,000 or $400,000, the Fed is in your financial life. If you carry credit card debt, you're paying more now than a year ago. If you're house hunting, your buying power just shrank. If you have a savings account, you should be getting a better return if you run a business. Funding expansion may cost more if you rent. Landlords often raise rents to cover higher mortgage costs. This is why understanding interest rate moves isn't just for investors. It's for everyone who touches money. So what can you do? 1. Pay down high-interest debt. Focus on credit cards and personal loans first. These rise the fastest when the Fed raises rates. Try to overpay, even just $25 extra a month, to reduce your balance and total interest paid over time. 2. Shop for better savings rates. Don't let your money sit in a 0.01% account while rates are at 5%. Move it to a high-yield savings account, money market fund, or short-term CD that actually pays you back. 3. Time big purchases strategically. If you're planning to buy a car or refinance a loan, know where we are in the rate cycle. When rates are high, it's a buyer's market for housing. Fewer buyers means more negotiating power. When rates fall, it's a seller's market. Prices often climb as demand rises again. 4. Stay informed, not alarmed. Rate changes don't mean panic. They mean pivot. Follow reliable financial news, watch what the Fed signals during meetings, and check in on how rates are affecting your own accounts. When the Fed moves, it's not just news, it's personal. From your wallet to your investments, understanding interest rate shifts gives you power. This channel exists to help you build that power, without hype, without confusion. Subscribe, like, and share so that we can continue making money make sense, and doing it the way school never did.